Today, I am going to discuss on the assessment of partnership firm. First of all, it is important to know what is partnership firm. As per the provisions of the Indian Partnership Act 1932, partnership is a relation between the two or more persons who have agreed to share the profit from the business which is carried on by all or any of them acting for all. The business of the partnership firm, whose activities may be looked after either by all the partners of the firm or any one of the partner on behalf of all the partners. Such of those partners who are looking after the affairs of the partnership firm are called as working partner or working partners. Who is a working partner? Working partner is one who is actively engaged in the affairs of the partnership firm or activities of the partnership firm or business of the partnership firm. Let us now discuss about when the partnership firm has to be assessed under the status of the partnership firm according to the provisions of the Indian Income Tax Act 1961. The said partnership firm has to fulfill certain conditions. Let me explain about what are those conditions. The first and the foremost important condition, there should exist a partnership deed. It's also called a partnership letter. Partnership deed refers to a document which contains some terms and conditions on which the partnership firm is formed. The first condition. Second condition, that is to be satisfied to assess the firm as a partnership firm according to the ID Act 1961, that the share of profit of each and every partners must have to be stated in the partnership deed. Then third important conditions under section 184 of the Income Tax Act 1961, the partnership firm that has to file a certified copy of the partnership deed with the income tax department along with the income tax return. These are the three conditions which have to be satisfied for assessment of firm in the status of the partnership firm as per the ID Act. So suppose if these conditions are not satisfied, suppose if the conditions which are written in section 184 is not satisfied, in such a situation, while we are going to compute the income of the total income of the partnership firm, salary paid to all partners, interest paid to all partners is not allowed as a deduction in the process of computation of the total income of the partnership firm. So let us now discuss about, here is one important problem on how to compute the income of the partnership firm when the partnership firm satisfies all the conditions which are laid down in section 184 of the Act. First of all, I would like to read the problem of the assessment of firm, that is the problem number, that is 1. Then I will straightway go for solving the problem on the assessment of the firm. X, Y and Z are the partners in a firm sharing profit and losses in the ratio of 3:2:1. The profit and loss account of the firm for the year ending 31st March 2019 is as under. Profit and loss account is given. Then first we shall go towards the debit side of the profit and loss account. Office expenses 25,000, bad debt 5,000, salaries 50,000, GST 10,000, provision for bad debt 5,000, donation to National Defence Fund 10,000, advertisement 15,000, then salary to partners X and Y only 30,000, 20,000 each, total 50,000 each. Depreciation 15,000, commission to X, Y and Z 10,000, 5,000 and 5,000 respectively, total 20,000. Interest on capital at the rate of 20% to these three partners, X 20,000, Y 15,000, Z 10,000. Total 45,000. Net profit is 1 lakh. Let's now go to the credit side of the profit and loss account. Gross profit brought down to 2,80,000, discount 20,000, commission 15,000, rent from house property 35,000. Let us now go to the additional information in relation to this problem. Number 1, office expenses includes rupees 2,000 paid as municipal tax on the house property let out and rupees 5,000 on the purchase of the furnitures. Number 2, out of the bad debts claimed in the profit and loss account, rupees 2,000 was disallowed by the income tax officer. Then number 3, depreciation allowable as per the income tax rules is 20,000 rupees. Next, number 4, X and Y are the working partners. Compute the total income of the partnership for the assessment year 2019 and 2020, assuming that the partnership firm has fulfilled the conditions which are laid down in section 184. Let us now go to the solving of this the problem of the total income of the partnership firm. First of all, we have to prepare a heading computation of total income of the firm for the assessment year 2019 and 20. Then we have to prepare a table showing the particulars, then amount of the rupees. So from the given profit and loss account, we have to compute the total income of the partnership firm. So how to compute the total income of the partnership firm? So we have to make the heads of income separately. First head of income from business. In the profit and loss account, net profit has been given. So here, net profit as per profit and loss account is 1 lakh rupees. So to this net profit, we have to add all the disallowed or inadmissible expenditure. So all those expenditures which have been debited to profit and loss account is not allowed by the income tax officer. They are not admissible. That's why such of those expenditures which are inadmissible or which are not allowed, they have to be added back to the net profit. For that purpose, we have to add disallowed or inadmissible expenses. Okay, office expenses, okay, no doubt. But cost of office expenditure includes the payment of municipal tax on house property let out, amounted to 2,000. And also the cost of furniture purchased 5,000. Since the furniture purchase is a capital expenditure, that the cost of furniture purchase which is included in the office expenses is not allowed. Then comes to the bad debt. No doubt bad debt is allowed. But while the income tax officer has not permitted the firm or has disallowed the partnership firm from claiming 2,000 rupees bad debt. That means 2,000 rupees was disallowed by the income tax officer. Hence, that we have added back that is bad debt disallowed by the income tax officer, which is 2,000 to the net profit. Then provision for bad debt. Provision for bad debt or reserve for doubtful debt is not at all allowed as a deduction. Then the donation to National Defence Fund. Though the donation will qualify for deduction under section 80G at the rate of 100%, but we have to disallow it while computing the income from business of the partnership firm. So donation to National Defence Fund 10,000 it is disallowed. Then the salary to partners, whether they are the working partners or the non-working partners, first we have to disallow the salary paid to the partners. Salary paid to partners X 30,000, Y 20,000, total 50,000. Okay, then depreciation. Here in the profit and loss account, the depreciation claimed by the assessee or debited to the profit and loss account is lesser than the amount of the depreciation which is allowed by the income tax rules. So when the depreciation claimed in the profit and loss account is less than it is allowed by the income tax rules, at that moment the depreciation has to be disallowed and has to be considered separately. First we have to disallow it. No doubt depreciation is an allowable one. But when the depreciation which is debited in the paid account is lesser than it is permitted by the IT Act, in such a situation, first we have to disallow that depreciation and it has to be considered separately. So depreciation 15,000. Commission paid to the partners, including X, Y, Z, 20,000 rupees. Then the interest on capital to partners. Here the interest on capital to partners is being paid at the rate of 20%. But as per the provision of the Income Tax Act 1961, interest at a rate of only 12% per annum is allowed. But herein, in this situation, the interest paid to the partner is at the rate of 20%. That means excess 8% interest has been paid to the partners of the firm. X actual interest paid is 20,000, excess interest 8%, that is amounted to is 8,000. Y, that is 6,000 rupees. Z, 4,000. Taken together these three, the items of the excess interest comes to be 18,000 rupees. So totaling these disallowed expenses, disallowed items, it comes to 1,27,000. Adding to this net profit, total this amount comes to 2,27,000 rupees. Okay, this is 2,27,000. But now, after the completion of this process, we have to go to the credit side of the profit and loss. There are certain items of incomes which are shown in the credit side of the profit and loss account, which are chargeable to tax either under other heads of income or they are being exempt from income tax. So all such items of incomes which are shown in the credit side of the profit and loss account and chargeable under other heads are exempt from tax, they have to be reduced from this amount. Yes, what are those? In the credit side of the profit, we have to make a heading: less incomes chargeable to tax either under other heads of income or exempt from income tax. Okay, what are those items of incomes which are chargeable under the other heads of income? In the credit side of the profit and loss account, that what I have read out, that is rent from house property 35,000. It is not coming into the head of the income from business, but it is coming into the head of the income from house property. So that has to be reduced, 35,000. After reducing this rent from house property from 2,27,000, amount comes to be 1,92,000 rupees. Then the depreciation, which is allowed by the income tax rules, are permitted as per the income tax rules is 20,000, as which was considered separately earlier, that has to be reduced here. So after deducting this 20,000 rupee depreciation as per IT rules, that is book profit comes to be 1,72,000 rupees. So here calculating or finding out of the book profit is very important. In the process of computation of the total income of the partnership firm, finding out of the book profit is one of the most important steps that must have to be strictly kept in mind by we people while we are going to compute the total income of the firm. Let me explain about what is book profit. Please remember, book profit is not net profit as shown in the profit and loss account. Book profit means it's a net profit as shown in the profit and loss account as increased by all the disallowed expenses or inadmissible expenditure, including salary paid to partners, all partners, excess interest paid to all partners, commission paid to all partners, bonus paid to all partners. In this context, we have to understand the meaning of the salary to partners. Salary includes bonus, commission to all partners. Okay, here after deducting this, so book profit that 1,72,000 rupees. Now we have to allow the salary to working partners. Salary paid to working partners is allowed, but it is allowed subject to some limit. Subject to some limit. Since this firm has specified a condition which has been laid down in section 184, salary paid to working partners is allowed subject to some limit or subject to some extent. Let me explain about what is the provision relating to the claiming of the salary paid to the working partners. Working partners here, X and Y are the working partner. Z is not a working partner. We have to take into account only X and Y. Whatever the salary, commission, bonus received by the working partners X and Y, that only should be taken into account. Then Z salary, commission should be ignored. Here, let me explain about what is the provision of section 40B with regard to the allowable salary to the working partners. So, suppose if the book profit is more than 3 lakh, at that moment discussion arises. So, on the 3 lakh rupees of the book profit, 90% of the book profit or 1,50,000, whichever is more. Then on the balance of the book profit, suppose if the book profit is more than 3 lakh rupees, of course, in this problem, book profit is only 1,72,000. It is definitely less than 3 lakh rupees. So here on the first 3 lakh rupees of the book profit, 90% of the book profit or 1,50,000, whichever is more. Then on the balance of the book profit, 60% of the book profit. So either this 90% of the book profit or 1,50,000, whichever is more. Here in this situation, since book profit is only 1,72,000, lesser than 3 lakh rupees, on the 1,72,000 rupees of the book profit, 90% of the book profit or 1,50,000, whichever is more. It works out to be 90% of 1,72,000, it comes to be 1,54,800 or 1,50,000, whichever more. So here either 1,54,800 or 1,50,000, whichever more, 1,54,000. But actual salary as per the provision section 40B, while we are going to claim the deduction in respect of the allowable salary in respect of the working partners, that is actual salary paid. Either salary allowable under section 40B, that is 1,54,800, or actual salary paid to working partners, whichever is less. Actual salary paid to X and Y, including salary and commission, is 65,000. Salary paid to X and Y is 50,000. Then X and Y commission ratio 10,000, 5,000, 15,000, total 65,000. After deducting this 65,000, either 1,54,800 or 65,000, whichever is less. So actual salary is 60,000. It is lesser than this 1,54,800. This 65,000 rupees has to be reduced from the book profit. Then we will comes to 1,07,000 rupees. This is considered as income from the business. Now let us go for this 1,07,000 income from business. Then while we are going to compute the total income of the firm, we have to take into account the other incomes. The incomes which are earned by the partnership firm under other heads of income. Here in this problem, only one item of income is there, which is coming under the head of the income from house property. This partnership firm has let out one house property and earned the rent amount. That rent is nothing but the gross annual value of the let out house property. So here the income from, we have to make a heading, income from house property like this. Then rent is nothing but a gross annual value of the let out property, that is 35,000. Then from the gross annual value, the assessee is entitled to claim, or the partnership firm is entitled to claim the payment of the municipal tax to the municipal corporation, that is amounted to rupees 2,000. After deducting this municipal tax from the gross annual value comes to be 33,000. Net annual, it is also called net annual value. Then from the annual value of the house property, as per the provision of the section 24 of the Indian Income Tax Act 1961, this partnership firm or any assessee, they are entitled to claim the standard deduction at the rate of 30% of the annual value. Here in this problem, annual value of this firm is house property is 33,000. So 30% of 33,000, it comes to 9,900. So this standard deduction is a fixed amount, irrespective of whether the assessee has incurred any expenditure in connection with repairs of the house, maintenance of the house, legal charges, collection charges. Fixed amount of 30% on the annual value can be cleared by the assessee. So it comes to be 9,900 on 33,000 into 30% is 9,900 rupees. This 9,900 has to be reduced from annual value of 33,000. So the income comes to be 23,100. Taking together this income from business 1,07,000 and the income under the head of the what is known as the house property is 23,100. The gross total income comes to be 1,30,100. Gross total income. So what is gross total? It is most important to know what is gross total income. Gross total income refers to which is the aggregate of income derived by the assessee under the different heads before making deduction under section 80C to 80U. In the ordinary language, it can be put it gross total income. It is nothing but income before deduction. Okay, now from the gross total income amounted to 1,30,100, this partnership firm is entitled to claim or eligible to claim the deductions which are provided under section 80C to 80U. Fortunately, in this problem, there is only one deduction which has been provided under section 80G, that is in respect of donation paid to the National Defence Fund. So here, donation paid to the National Defence Fund that qualifies for or that is eligible for deduction at the rate of 100%. So 10,000 rupees donation has been paid to National Defence Fund. So that 10,000 rupees has to be reduced from gross total income of 1,30,000. Then figure comes to 1,20,100. This is called as total income or taxable income. Taxable income of the partnership fund. Here in this problem, while I was reading this problem, one item that is of the most important item, that is the GST, goods and service tax. Please remember, my dear students, income tax no doubt it is not allowed, it is inadmissible. Sales tax is allowed. GST is also allowed as a deduction, like a VAT or sales tax, commercial tax. GST, goods and service tax is allowed. So in this way, that we have to compute the total income of the partnership firm. Thank you. Thanks for listening my video. Thank you and